Well, in this study, we're for the first time studying lapse and surrender experience. We've always collected that data, and we decided this time that would be something that's valuable to the participants is to go ahead and study that data as well and release the findings there.
You're listening to Rethinking Insurance, a podcast series from WTW where we discuss the issues facing P&C, life, and composite insurers around the globe, as well as exploring the latest tools, techniques, and innovations that will help you rethink insurance.
Welcome to Rethinking Insurance. I'm your host, Carrie Kelly. On today's podcast, we will be discussing the findings of the Willis Towers Watson TOAMS 5 Industry Mortality and New for This Year Lapse study. My guests today are Kim Steiner, a Senior Director at Willis Towers Watson, based out of our Dallas office, and Boyang Meng, a manager in our Atlanta office. Welcome, Kim.
Thanks, Carrie. Happy to be back.
And welcome, Boyang.
Thanks for having me.
All right, I'm happy to have you both on the show. Now, as you may know, we like to learn a little bit more about our guests before we jump into our main topic. So today's question is, what do you like to do outside of work at WTW? And maybe we'll start with you, Boyang.
Yeah, sure. I've recently started trying to learn skateboarding again. That's a fun little thing I've been picking up. And I basically learned from scratch. I haven't stepped on one since I was like 15.
Nice. And how is that going?
I end up kicking it into my shins a lot. So it's pretty painful at times, but it's fun.
Excellent. Kim, how about you?
So the most fun thing I do outside of work is coach my two sons' sports teams. So my 8-year-old plays basketball and my 6-year-old plays baseball.
Nice. All right. So why don't we jump into talking about TOAMS 5? And maybe the best place to start is with some quick background.
So TOAMS is our industry experience study. We conduct it about every 4-5 years or so. So we collect data from a wide range of companies. For fifth edition, we have 21 participating companies. So we're covering the exposure years 2015 through 2018, and with the number of large number of participating companies that we have, we're able to get quite a bit of experience. So we had more than 1.7 million deaths on account basis and more than $29 trillion of face amount exposure.
And so, from the name, this is our 5th time doing this study. So what's new or improved for this edition of the study?
Well, in this study, we're for the first time studying lapse and surrender experience. We've always collected that data, and we decided this time that would be something that's valuable to the participants is to go ahead and study that data as well and release the findings there. One other thing that we've continued that I think is worth highlighting is the use of predictive analytics. So we really focused on that in TOAMS 4, did a bit of it in TOAMS 3, but we've kind of refined that and have even better results there, I'd say, this time around.
All right. So maybe we'll start by talking about some of the findings on the mortality side and then move on to the lapse piece. But what are some of the more interesting trends that you saw as you were reviewing the mortality experience?
Yeah, so we definitely saw some, interesting trends relating to mortality differentials across the product. So we do kind of separate and compare, both term products versus whole life, UL, VUL, both with and without secondary guarantees. And what we saw this time was that, the product type that had the highest mortality ended up being universal life without secondary guarantee. And, that's a little bit different from previous studies. Usually in the past, whole life has been the product, with the worst to the highest mortality. But seeing UL come out at the highest was definitely different and definitely a surprise. Kim, have any thoughts on what might be driving that?
Well, I think one thing that we were able to do this time as compared to our prior study is we were able to put an interaction between face amount and product. So I think in our prior study, we had attributed maybe some of the whole life impact in the face amount factor. So this time, I think potentially we did a better job of separating that out.
And we have also seen, some corroborating experience, amongst the industry. There have been a lot of rate actions on UL products, in the roughly same time frame of the experience that we're collecting here. So, differences
right.
from, the differences from our previous studies, but not completely unheard of.
That makes sense. Anything else?
I guess some of the other findings that we had similar to TOAMS 4, we did study preferred wear-off, which is something that is really a hot topic in the industry. So the introduction of preferred classes happened in the industry about 30-ish years or so ago, which may sound like a lot of years, but in life insurance terms, it's not really that many durations into the life insurance policy. Additionally, the earliest risk class structures only had two classes, a preferred and a standard. So we have the most experience on that. And then about 10 years later-ish, they started introducing more preferred risk classes. So we have even more limited durations to study that. But what we have been able to study, we have 4 additional years since our prior TOAMS study, is we've been able to look at how that preferred discount may wear off. And what we have seen is that it does wear off more strongly by age rather than duration. So we did study that with the predictive analytics. And one interesting thing from the results is that we still do see, even at the highest ages, even attained age 85, where we still have a decent amount of experience, there still is a pretty big differential for the best preferred risk class. So we're still seeing lower mortality for those best risks.
Yeah, and it's definitely something that you might normally expect to wear off eventually at some point, right? Might expect all classes to eventually converge. Even with our pretty large industry data set, we do eventually run into credibility issues. The number of death claims we have at individual ages really does taper off after age 95. So, I think, in terms of interpreting what we've seen in the model of there still being a discount, there still being a gap, at mortality at age 95, it's not necessarily us saying that we expect that to continue as much as we don't have enough data to prove that it continues wearing off, but we certainly would expect it to.
So I guess particularly on this preferred wear off, where we're talking about the changes that you've seen between the two studies, but in general, do you see companies incorporating assumptions for preferred wear off into kind of their best estimate assumptions, or is that still relatively new to the industry?
I would say that most of our clients are incorporating some amount of preferred wear off. Because there is so much judgment involved in that assumption, there's a pretty big range around what we'd see. But I think we are now to a point where I would say that it'd be an exception for someone not to have some element of preferred wear off in their assumption. Not sure if you disagree, Boyang.
Yeah, I think most companies wear it off, age or duration or both. But it's tricky setting the parameters, especially at a company by company level, usually not having enough experience to really know when to end it. But usually, some element of wear off.
The industry tables do have different tables for different risk classes, and they do have an element of wear off in them as well. So if nothing else, a lot of companies will kind of mirror the wear off that is in those. I will say that we're seeing that preferred differential last longer than it does in the industry table.
All right. And so are there any other thoughts you want to highlight on mortality before we move on to lapse?
Yeah, so Kim started talking about this a little bit earlier, but we did have another new finding this time related to face mount, especially the relationship with face mount and product. So in building kind of interactive effects between product and face mount, what we observed traditionally is that higher face mount policies generally have lower mortality experience than lower face mount. So, a decreasing slope there, but the slope differs between permanent and term products. The term products have a little bit steeper of a slope, so especially above 100, 250,000 term policies will have lower mortality than an equivalent whole life policy. And that holds true all the way till around 2.5 million, where we actually see that slope starting to reverse. And we see term policies show, at the very largest face amounts, higher mortality than whole life, which, suggests potentially some degree of anti-selection for, the very largest policies.
I think one other thing I'll add while we're on face amount, we did have an additional finding in looking at the face amount patterns that generally, as Boyang said, mortality tends to decrease with face amount. But one other element of anti-selection, like he talked about with those highest face amounts with term, is just before common underwriting breakpoints. So as you're moving from not sending someone out to collect fluids to sending fluids, just before that break point, you'll see the mortality spikes up. So it seems like there's some anti-selection going on with the agents who are aware of conditions that may cause one of their applicants to not get into the same risk class if they moved up just a bit higher in the face amount and got that additional level of underwriting. So that's one other interesting finding that we had with the study.
Yep. Yeah, I think we saw that, for the first time with TOAMS 4, and we're able to, observe the same pattern here on 4 additional years of data. And it's an interesting narrative, right? If you want 250,000, 245 is practically the same, but might require less in terms of underwriting.
All right. So a lot of interesting trends in the mortality experience. So as we said at the start, this was your first time looking at lapse in the TOAMS data. So what were some of the key findings from that analysis?
Yeah, so I will preface to say that, most of our lapse experience has been, classically focused so far, but we'll be starting our predictive analytics focus soon. But do definitely have some interesting findings. When we studied it, we did generally focus and kind of separate the experience by product and duration. There obviously tends to be pretty big differences by product and big differences in how policyholders behave over time as surrender charge periods, will expire.
I mean, we observed other factors that impacted policyholder behavior. A lot of them tend to vary by product, but as Boyang said, some consistent themes by duration in terms of higher lapses, surrenders early, and kind of leveling off. Specifically for level term products where you can buy different term periods in terms of coverage. So you might get coverage for 10 years, 20 years, 30 years. All else being equal, we saw a higher lapse experience on the shorter level term period. And that's both within that level term period and then also at the end of the level term period where you can switch to an annual coverage with an increasing premium per year. There's often a shock lapse, and the level of that shock lapse is higher for the shorter level term periods. We also saw that on that shock lapse specifically, which is a very interesting area of study for the industry, that the experience is correlated with the size of that premium jump. So the larger the premium jump, the larger the shock lapse that we were seeing.
Yep. And then, for permanent products, especially for whole life, we generally do look at all the kind of terminations, both lapse and surrender kind of an aggregate. We did see, unlike other permanent products, a pretty flat relationship by duration. So not a huge difference. Early durations might be 3% or so. And even in the ultimate period, 20 durations, 26 plus, only drops down to 2.5%. So those are pretty stable over time, unlike flexible premium products with UL, VUL, IUL, where we see some more significant differences.
I mean, another trend that we saw that was interesting to me and not surprising given other industry data that we've seen, but kind of reinforces, is that products with secondary guarantees, which is something that is common on some UL products, they have lower lapses, which is to be expected because the policyholders are buying that coverage for the protection. So they're going to keep it in force to a greater degree than a similar product without that secondary guarantee. We did see something a little odd in the lapse behavior in that for those products with the secondary guarantee, about 20 years out, we saw a little bit of spike lapse behavior, which we hypothesized was likely driven by products that had term-like premium structures in that they had a level premium up until that duration, and then that premium started to increase. So that was something that was a bit unexpected, that spike about 20 years out.
Yeah, and one that's kind of hard, a little bit difficult for us to study, given some limitations with our data. We couldn't completely partition out or identify all the policies that had the term-like premium structure. A lot of policies were just kind of unknown. And we did see, a smaller, that will be a blend of whole life type level structure and a term like premium structure. But yeah, definitely, even with the amount of data that we have, definitely still some challenges with quality and granularity of it.
When you say term-like structure, just to clarify, you're saying kind of level premiums on those ULSG policies and then jumping to increased premiums around that duration 20?
That's right. It's the premium structure so that it's level for that time period, just like a term product would be, and then it starts to increase each year. One other interesting finding, which kind of corresponds to the mortality, is that there are significant differences by face amount band, which you might expect, but we did see that as a pretty big driver. And it's small face amount policies tend to have higher lapse rates than larger face amount policies.
And the same thing for, smokers as well, higher mortality on smokers. We also saw higher termination in smokers, and then substandard business as well, higher lapse and surrender rates on substandard business than standard issue or preferred. And then, talking about preferred class, we did see also differentials in termination experience between preferred non-smokers and residual standard non-smokers. Generally, preferred classes did have lower termination rates, but that differential did wear off over time. So where kind of initially, the preferred policies might have 30 or 40% lower termination experience, by the end of the leveled period, that gap is more like only 10% lower.
Great. Well, definitely a lot of interesting findings, both here on the lapse and on the mortality. So I know you've done a lot of work on TOAMS already, but are there any additional passive analysis that you're hoping to do with this experience?
Yep. So like I mentioned, with our kind of lapse and surrender study, we'll be kind of moving on to doing predictive analytics for that. And then we do have a few other things in the pipeline, including joint life mortality and some more smaller topics such as mortality, seasonality, perhaps a few others.
I'll just add the joint mortality in particular, I think, will be of a lot of interest in the industry, as there isn't much joint experience available and most companies don't have a credible amount of it themselves. So I'm really excited about that upcoming analysis.
All right. So we've covered a lot of interesting findings from the study, but if you had one takeaway for people as they're trying to digest all of these findings, what would it be?
I think for me, comparing the results that we saw in TOAMS 5, comparing it to, our previous TOAMS studies or other industry studies, one thing that I always kind of think back to is this quote I read once from a famous baseball statistician called Bill James, which is that if you have a statistical model that never matches up with your expectations with the eye test, your model's probably wrong. But if it never surprises you, it's actually probably useless. So really, ideally, you have a model that 4 or 5 times matches what you expect, and 1 out of 5 it surprises you, and then you might have something valuable there.
And I could not say it better than that. So I think that's great, Boyang.
All right. So where can people find more information about the TOAMS 5 study?
Yep. Yeah, we have an article published on our website, wtwco.com, with some additional commentary on findings from TOAMS 5, along with contact information for those interested in finding out more about purchasing or participating in future TOAMS studies.
Perfect. All right. Thank you, Kim and Boyang, for joining us.
Thanks for having us.
Yep. Thank you.
And thank you for listening to Rethinking Insurance. Have a great day.
Thank you for joining us for this WTW podcast featuring the latest perspectives on the intersection of people, capital, and risk. For more information, visit the Insights section of WTWCO.com.